everyone, welcome to another Presentation Expressway. Lots going on in the marketplace. So let's update the driving factors and forces between what's happening with interest rates, real estate, and a recession. Lots to talk about. Let's get right to it. So I'm going to share my screen here. And when we take a look at the current marketplace, inflation is a big buzzword. We've got inflation over 8% now as measured by the Consumer Price Index. And while it might peak temporarily, over the summer months, we could see it come back. Inflation is the arch enemy of mortgage rates because a receiver of those mortgage payments is typically receiving a fixed payment over a long period of time. And inflation makes things cost more. So the money doesn't go as far that you're receiving. It's a fixed payment, but it buys less and less. The only way that you can combat higher inflation if you're the receiver of mortgage payments is to charge a higher interest rate to offset the more rapid rate of erosion. Now, a lot of talk about the Fed. We anticipate that the Fed will be hiking interest rates quite a bit this year, but counterintuitively, it doesn't necessarily mean a bad thing for mortgage rates. When inflation slows down because the Fed hikes rates to slow economic activity, mortgage rates respond favorably and decline. But the balance sheet, Fed's amassed like $9 trillion between mortgage bonds and treasuries that they said they would now start to allow to run off as they mature, as they collect principal payments. Instead of reinvesting them, which is what they had been doing, they would allow a portion of those, maybe all of the receipts that they have, to run off their balance sheet and reduce their holdings. That means less purchases of mortgage-backed securities. Now, the other big buzzword is recession. We've been talking about this late 2021 and in our forecast for 22, where we said late 22, early 23 looked like a recession was on the horizon. So what does that mean? What does that mean for mortgage rates? And what does it mean for housing? Let's take a quick look. First, let's take a look at the Fed and do a quick recap. Now, if we go all the way back to the 70s and 80s, late 70s, Arthur Burns was the Fed chair. He watched inflation go from 7 to 14%. And as a result, remember we said mortgage rates have to go up when inflation goes up, and it did. It went from 12 to 18. Paul Volcker came in and he took our Fed funds rate already at 11 to 20% within 2 years, slowed the economy enough so that inflation went way, way down, and mortgage rates, because inflation dropped, mortgage rates went down. So let's understand this. Fed funds rate way up because inflation declined due to a slower economy, mortgage rates dropped. So Fed funds rate up, mortgage rates drop. But there was a recession. Just about every time the Fed tries to slow inflation in the economy by hiking rates, we get a recession. And the stock market didn't like it. Under Greenspan, he also saw inflation rise. And as a result, mortgage rates rose, just like we've been saying. Now, he took the Fed funds rate almost 2% within a year and slowed the economy enough to where inflation dropped. And because inflation dropped, mortgage rates dropped from 8.5% to 3.5%. So think about that. Hiking rates, and because he slowed the economy enough to kill inflation, mortgage rates decline. So pattern here. But again, part of that pattern is recession, almost unavoidable, and bad stock market performance. Our guy today, Jerome Powell, has seen inflation go from 1.5% to 8.5%. Mortgage rates go from 2.5% to 5%. There's possibility he could take the Fed funds rate, which was at 0. Now he's bumped it 0.25. And there are thoughts that he could get to somewhere near 3% by the end of 2022. That should cause inflation to drop. And that means mortgage rates should drop towards the end of this year. We think a recession is pretty much unavoidable. And, the stock market, if you go by history, it might be difficult for the stock market. Let's take a look at the last time we had been in this situation where the Fed was hiking rates, but had a balance sheet that they started to allow to run off. So it started at the end of 2015, December 2015. The Fed hiked by 1/4. And what happened here? Mortgage rates actually dropped. Now, as inflation started to creep back in, mortgage rates went up, but then the Fed hiked again and mortgage rates dropped. The Fed hiked here, mortgage rates dropped. The Fed hiked here, and after a bump up, mortgage rates actually wound up getting lower than where they were when the Fed hiked rates. But then there was talk about a runoff of the Fed's balance sheet, similar to what you see today. On the talk of it, rates started moving up. When they started the balance sheet runoff, they started to really rise. And as that runoff continued, even though the Fed hiked here, the runoff overwhelmed it, and we started to see mortgage rates rise until Fed rate hike. We saw a little bit of a dip here, but that runoff continued to pressure mortgage rates a little higher. But then the hikes eventually started to take hold here, because now you had 1, 2, 3, 4, 5, 6, 7 rate hikes. And here's the 8th one. So the Fed taking rates up about 2%. And finally, mortgage rates started to respond as the economy slowed and really started to move down here and then cascade lower. And then when the Fed slowed their runoff because the economy was really slowing, you saw a big drop. And then when they stopped the runoff of the balance sheet, well, then you see a huge runoff here. So very constructive to learn from this, because we can see that mortgage rates, while they're a little bit elevated now, there's a bright future, even though the Fed's going to be hiking once we get past the period of the Fed runoff. Now, you've been hearing a lot about inversions in the yield curve. A lot of times what that means is the 10-year Treasury is yielding a lower rate than the 2-year Treasury. That's abnormal. The longer you tie your money up, the bigger the risk, you should get a greater reward. And when this happens, it's a great indicator of recessions. Now, in the past year, we've seen the spread between the 10-year Treasury, when you take that yield minus the 2-year, it stays positive, but it's getting closer and closer and closer until just recently it went upside down. The 2-year was yielding higher than the 10-year. That has a lot of people saying there could be a recession in the wings, and we agree with that. As you can see, it's been pretty reliable through history in the 70s, 80s, 90s. Every time you get that inversion, a recession follows. And once again, 2000s, late 2000s, 2019, had a 2020 recession before COVID, and now we have it again. So while history may not exactly repeat itself, it does tend to rhyme, just like Mark Twain said. So what does that mean if we have a recession? Now, there's other indicators too that we want to watch out for. And one very reliable one is the unemployment rate. When the unemployment rate reaches its lowest level and starts to rise, it becomes a great indicator that we're going to have a recession. And as you can see, go back to the 40s, lowest level starts to rise, recession. Again. Every time with 100% accuracy, the most recent one, here's where we are today. Now, could we go a little bit lower? Have we started to move up in the unemployment rate? Not yet, but perhaps later in the year, as the Fed hikes start to take hold and we start to see things slow, that employment rate starts to tick up. As you can see, really reliable forecaster of recessions. So what does that mean when you have a recession? Is that a bad thing? If we get one like we're thinking the end of this year, early next year, well, as far as mortgage rates are concerned, we've seen drops in mortgage rates every single recession, and by quite a bit, I might add. We've seen mortgage rates drop. Okay, so recessions have to be bad for real estate then, right? Well, not exactly. As we look at real estate historically, you can see that in the 60s, 70s, 80s, 90s, every time we had a recession, prices actually did well and went up quite a bit afterwards, even in early 2000s. The one anomaly here was the housing bubble. When you have zero down, fog up a mirror loans where you're doing no income, no asset, no job, and poor credit scores, and you're still getting a mortgage on multiple homes, well, that housing bubble was overcooked. And that actually led us into the recession. It wasn't the recession that caused home prices to decline. After finding our footing, you could see prices have gone up quite a bit since then. And actually, the last recession, true to form of the previous ones, other than this one time, so 8 of 9 recessions, home values going up and continue higher. We believe that the housing market today is much stronger because, look, in 2007, there was a lot of inventory, 3.7 million units for sale. Today, much less than 1 million units for sale. So lots less inventory, but meanwhile, households since then have grown. You could see households are much, much greater than they were in 2007. So you've got 14 million more households fighting for 3 million fewer homes. We think that while we have a period of time here to contend with, the future looks very bright.